Welcome back to another episode of Palisade Radio. I am your host, Rema Mutlu. And on today's show, we have David Keller, who is the president of Sierra Alpha Research. Welcome to the show, David.
Thanks so much, Graham. Good to join you.
I want to start by talking a little bit about your background. And can you tell us how you started your career within the financial markets, David?
Absolutely. So I've been in the financial industry for about 19 years. So I started just after the market top in March of 2000. So my initiation into investing was in a secular bear market, which has probably scarred me through my entire career. But it was certainly a good place to learn about risk management and just investor psychology as people dealt with all of that. But I actually studied music and psychology as an undergraduate and got hired by Bloomberg in New York. And at a firm like that, they did a really good job of hiring a bunch of liberal arts majors like myself and a bunch of finance, econ sort of majors as well. And then we all got in a big room together and helped each other understand investing. But I also helped those guys think about speaking and how to listen and how to be creative and all those things. And in the end, we kind of came out pretty well-rounded. So for me, with a background in music and psychology, when I first saw a chart and learned about technical analysis and investor psychology, behavioral finance really wasn't a thing yet, but it was more about psychology and sentiment. I immediately gravitated toward it. I think partly because of the mathematical relationship, looking at the statistics of stock price movements, but also just thinking of getting inside other investors' heads, just completely resonated with my studying of psychology. So I've always appreciated that, getting into that sort of side of the market. And then from there in 2008, I was hired by Fidelity up in Boston, and I was a managing director of research there for about 8.5 years. And I ran the technical research department there. So we worked with all of the equity fund managers, the big mutual funds like Contrafund and so forth, and helped the fund managers with positioning and general market orientation. And then for the last 2.5 years, I've been running my own research firm called Sierra Alpha Research. And I work with institutional investors and also financial advisors, helping them develop better routines for their investment process, but also understanding the markets from a technical and behavioral perspective.
You have stated in the past that everything is based on probabilities and never certainties for the markets. Mm-hmm. And I guess in general, essentially humans want to seek certainty. And when making a trade or an investment, the more certain they feel, the more likely they'll put on the trade. However, in the markets generally, when all the uncertainty and risk has been taken out of the trade, there usually isn't much upside left. So it'd be interesting to know how you define your risk reward strategy when entering the investment or speculation.
That's such a great question. And I think you've hit on just a beautiful point. And as humans, we want to have certainty. We gravitate towards certainty. And that's in our own decision making, but also in our belief that there are experts that just know the answer. We, even faced with the evidence that that's probably not the case, we absolutely want to believe that experts know what's going to happen. When in reality, if you really lay out the facts, we probably know that that's not the case. So it's funny, as investors, and I know from coaching junior analysts, we coach investors and analysts to be very, to pound the table, have conviction, be certain of your opinion and justify it. And when that opinion is questioned or when it's brought into question either from others or from the market movements themselves, you dig in your heels and you pound the table and you explain why you're still right. And as a result, that's very, very dangerous because you're getting wed to a particular point of view, which probably for a good investor, about 47% of the time is probably going to be incorrect. I mean, investors, broadly speaking, tend to be wrong about half the time, from what I've seen, which means the game is not to be right all the time. The game is to recognize all those times when you have the wrong position and that you need to recognize that. So getting to your question on risk and reward, I think it's so important. And the reason why that's important is when you're laying out a position, or for me, making recommendations or giving an outlook on what I see for a particular asset or particular market, it's never about here's what I think and this is what you need to do. It's here's what I think and here's what I think you should do, and here's when I would know I'm wrong, and then here's what I would do. So phrasing it in terms of risk or reward is defining your upside and also defining the potential downside that you're comfortable with and making it specific. What a lot of people do incorrectly, I think, is they put on a position or take a point of view, and then they worry about the risk once things start going wrong, right? So the market moves against your position, then you try to scramble to define, okay, hold on, how bad is this going to feel before I'm ready to make a change? And of course, then we are letting our emotions drive the decision as opposed to more of a rational perspective. So at the very beginning, I put on a trade. Here's my potential upside. Here's where I'd be happy with the movement. Here's my downside. And if XYZ happens, regardless of what else I think, I'm going to make a change to the position. I'm going to reconsider it. So for me, when I'm making recommendations with clients, it's always defining, here's where I see gold going. And if this happens, then that was wrong. And I have to question my thesis. And again, I encourage people to literally write it down on a piece of paper, enter it in a journal somewhere where you cannot decide later that might not have been correct. You want to lay it down right up front from the beginning, and then you are much more likely to stay true to it.
Let's talk about a few specific markets, mainly gold and silver. And what I want to understand is, what is more important to you when you look at these markets? Is it the technicals and the recent price action, or is it the macro big picture in terms of the global economy, interest rates, policy decisions from the Fed that create your outlook for the precious metals? And what is your outlook for this sector over the long term, David?
Sure. It's a good question. And I think, to be honest, my short answer is, I think a thoughtful investor uses both of these inputs in tandem. And by both, I mean sort of the fundamental drivers, the macro drivers, and gold obviously is so macro driven. There's all the thinking of what could affect the price of gold from a big picture perspective. And I think that's very important. But also, if you focus 100% on that and you ignore the price action, if you ignore the signal that can be derived from the price of gold and from the gold ETFs and the gold miners, I think you're missing out on a good source of potential data that could help you understand more of the supply and demand behind the assets themselves. And what I mean more is just the fear and greed that drives people to buy or sell gold at any given moment. So I think, again, a thoughtful investor, I think, uses a good combination of the two. So for me, the general way I've approached gold from a technical perspective is looking at the overall price movements. And when I'm looking at the long-term chart of gold, again, keeping it 100% simple, technical analysis 101, gold is in a pattern of higher highs and higher lows. It is undeniably in an uptrend, and you have to respect that. So if you make any decision about where you think gold is going to go from here, you have to remember that you are playing within a pretty bullish trend of gold breaking out. I think the long-term chart of gold, if you look at the last 4 or 5 years, it's this beautiful long-term base where a number of times it got into the mid 1300s, 1360 or 70, if I remember right, and bounced back a number of times, and then finally broke out earlier this year. And so from a technical perspective, I call it a big base breakout, a congestion range, a level at which buyers and sellers have sort of come into agreement that, an asset is worth about X. And then all of a sudden that's redefined. Then the price breaks out to a new high or a new low. And that tells you that there's something different. And in this case, telling you that there's more constructive price action in the future for gold. So long term, I think that the chart looks very good. I could see gold going much higher from here over the coming years. And for me, that lines up from a macro perspective with more of a cautious outlook for equities based on, a number of things, I think, based on, U.S.-China relationships and how that might play out, based on the fact that we've had such a run in stocks that at some point you start to question how much further upside you can have. And I think given some limited upside in stocks, I think precious metals are a place where people will continue to rotate even more than they've done so far. In the short term, though, I think it's interesting with the chart of gold, that you have some divergences right now. And short term, we're recording this end of July. And so, we've had a pretty good bounce up in gold, got up to the 1440, 1450, and then just pulled back a little bit in the last week. But if you look at the momentum, and I would measure that with something like RSI, which is the relative strength index, sort of a simple measure of short-term momentum, you have higher highs in price, lower peaks in the RSI. And that happens a lot around market top, short-term market corrections, where the market's moving higher, but there's less and less momentum on each of those upswings. So for me, it's sort of a perfect storm chart-wise, where you have a long-term strong chart, a short-term weaker chart, which I would argue presents an opportunity where a good investor could get in on short-term weakness and benefit from the long-term uptrend.
In one of your recent blog posts, David, you talk about the types of books you read that help you to become a more thoughtful investor. So let's go into some details about that, and also talk about how other disciplines not related to finance can actually help improve your investment framework. You talked about your background at the beginning, so can you talk a bit more about how this relays into your general thinking?
Absolutely. I'm a big fan of people like Charlie Munger who have talked about the multidisciplinary process, right? So thinking of all the other disciplines, everything outside of investing, and how that can help enrich your life, but also enrich your thinking and help you become a more well-rounded investor. And from my time at Fidelity, it was funny. I arrived there in 2008 expecting people to be very heads down, looking at stocks, looking at companies, and that's it. And a lot of my conversations with portfolio managers were on a lot of different things, because I realized if you really want to understand how an oil stock is going to trade, you really need to understand the environment for oil. You need to understand, the history. You need to understand how the market has evolved over time, and that means you have to read a lot of stuff outside of a 10Q, outside of a financial statement. So for me, I've always enjoyed the fact that as an investor, it opens the door to all the other things that you can learn about. And I think in some ways that means reading books written by some of the great investors, great managers, but also it's non-financial related things. And a couple books that I've read recently that come to mind. One was a book about the Battle of Britain. This is, World War II and the air battle going over Europe, and specifically going over the United Kingdom, and how that all evolved. It was called With Wings Like Eagles by this guy, Michael Korda. And the reason why I think it's a fascinating book is because it has a great leadership lesson and a great management lesson. And basically the pilots who were flying around were all young men. The air traffic controllers, the people that were coordinating the flying from the UK, were all young women. And the men were having trouble, the pilots were having trouble trusting these controllers that had never flown an airplane. They're thinking, how are they supposed to tell me where to go? Like, they've never done this. They have no idea what this is like. And so what the generals, the people in charge, did was they started rotating young pilots through the air traffic control system, had them actually sit with these women, see what they were seeing, saw where they got the information from, saw the maps that they were looking at, and they literally had the big room with the maps laying out where enemy aircraft were. And the more that they did that, those pilots would go back and tell all of their pilot friends, listen, they know what they're talking about, and here's why. And it was a great lesson in terms of understanding how different parts of an organization are operating. And as an investor, knowing that you can't just look at your point of view, your positions, your portfolio with the blinders on, you have to understand that that's part of a whole framework of other things that are happening. And you need to understand, you need to put yourself in other people's shoes to really understand what's motivating them. So I think reading books like that are not financial related are really helpful. I also, in a lot of my writing and a lot of my working with investors, I refer to other disciplines. And so I'm a student pilot, and I'm a classically trained musician. And so I spend a lot of time reflecting on the relationship between, for example, flying an airplane and what it means to be a thoughtful trader, a disciplined trader. And the reason how I came on that is when I was learning to fly originally, and this was in a Cessna 172R, which is a pretty classic training airplane. My flight instructor would actually trade stocks when he wasn't up in the air. And so when he learned my background, there's a lot of dead time when you're flying around in the middle of the air. You don't have a lot to do, but just kind of look at and speak. And so we would talk about the markets, talk about stocks, and we very quickly started to find the similarities between investing and flying an airplane. And there's so many times, so many examples that I can draw. But the one I would point out in particular was what caused me to name my firm Sierra Alpha Research. That's actually slang, a pilot slang for situational awareness. And situational awareness is the idea that when you're flying in an airplane, you have to have an understanding and appreciation of what's happening around you. Part of that is having a good paying attention to your instruments and seeing what's in the cockpit, but also looking outside of the cockpit and understanding what's happening around you. And if you forget to have good situational awareness, you do things like fly into the clouds, fly into a mountain, fly into the ground, run out of fuel, all these things that will end your flight and potentially your life prematurely. So you learn very quickly that you have to have a good awareness of what's going on outside you. And it's so funny, as investors, we so often have our heads down. We focus on a particular trade, a particular market, even something like mining stocks, and then forget the fact that the movements of those companies are part of a much larger machine. And if you don't have a good awareness of what's going on all around you, a lot of times the best investment opportunities, I would argue, are left on the table. So what I've learned from things like flying is just have a good disciplined way of approaching investing, and also having a good awareness of what's going on around you. And that means you have to thoughtfully look at the information that you have available to you.
Some excellent advice there. Okay, towards the end of the dot-com boom, there were many financial magazine publications continuing to predict that the bull market will keep going to higher highs. And most recently, there was a Business Week magazine cover telling everyone that the death of inflation was here. Many gold bulls signaled this as a potential key turning point for the precious metals sector. So are these magazine covers a good contrarian indicator in your view, and should investors take them seriously?
That's such a great question. And, at my time at Fidelity, we had a chart room, which is this beautiful physical space dedicated to market history and charting and technical analysis, and learning from the lessons of contrary opinion for decades. And the magazine covers you just referred to, that idea has been going on for decades. And over the long term, it absolutely tends to play out. And the reason why is when a market gets very weak, and I'm thinking in particular 1982, there's a 79 to 82, that whole period, there was covers like the death of equities, and magazine covers predicting the ends of equities as an asset class, because they were just never going to recover. And this is just before the biggest bull market in US history. And then when the market appreciates, as you mentioned, the dot-com bubble, 98 to 2000, you have covers like GetRich.com, The New Economy, The New America, all talking about this new way of valuing companies based on eyeballs and not on business plans. And as we know, that ended up being essentially the top of the end of that, of the technology bubble, and a redefining of what companies had to do. So over many examples, and that's happened through the housing bubble in 2006, 2007, you have all these examples of where magazine covers reflect the opinion of the masses, where people are at. And if you want to sell magazines, you sell things that are going to resonate with your potential readers, and that's why it tends to play out. So the covers that you mentioned more recently, I think that's absolutely the case. When you have predictions that the market will go not just a little higher, but astronomically higher, you have to question whether that's buying into or selling into a euphoria that is probably going to exhaust at some point, right? Markets top out not because or what I would say is they top out because of an exhaustion of buyers. There's no one left to push it any higher. So when a magazine cover reflects an ultimate euphoria, you have to question who is going to come in and push that market even further that hasn't already bought in. And that's when things start to top out. I would say this, though, I always hesitate with something like a magazine covers. I think they're really interesting as a sentiment gauge, and they're really interesting to illustrate a long-term inflection point. However, in terms of short-term timing, I think you have to be careful. And that's where I think recognizing that sort of sentiment and being at an extreme is really key. What that tells me is it puts it on my radar. And then I want to look at the price itself. And I want to see when the price actually recognizes the euphoria. So the euphoric headline saying, market's going to go to 1 million, puts it on the radar. You then want to look at the price and start to look for some of the divergences that I mentioned in the short term you're seeing with gold. Look for a market making higher highs, and momentum and breadth, and all of those indications of inner strength start to roll over a little bit. And that will tell you that there start to be some chinks in the armor, and then you can really start to make bets on a reversal in the market.
Fantastic. Okay, as we begin to wrap up today, David, is there anything else you wish to talk about?
Yeah, absolutely. I mean, and I love this question. This sort of thinking about your investment process and how you approach things, I think, is so key. And what I would just leave people with, I was just writing for my blog earlier today about your morning routine. I spend a lot of time with my clients, with a lot of financial advisors and institutional investors. We first talk about what your investment objectives are. Let's say, for example, you were a long-term investor, you like looking at precious metals. Perfect. So how do you start your day? And I don't mean showering, eating, meditating, whatever you do first thing. That's all important. But I'm thinking as an investor, what's the first investment related information that you look at? Is it your portfolio? Is it financial news? Is it your email? Is it blog posts? Are they charts? And I would be very thoughtful about what that very first thing is, because I would argue that sets the stage. You're priming yourself for how you're going to think about the overall market. So for me, most of my clients, or many of my clients, are long-term investors looking at equities and looking at many markets, but really starting with equities. That's the benchmark. That's the return that they are trying to, meet or exceed. So if that's what you're trying to do, then I would argue the very first thing you should look at is the long-term trend in the equity markets. I would, again, I'm a chart guy, so I would look at a 5-7 year chart of the S&P 500, just the long-term trend. And that should be every day. That should be the very first thing you look at. Because otherwise, if you start with financial media, which is going to be very short-term oriented, if you look at your most recent email newsletter, that's going to be relatively short-term oriented. If you look at your portfolio, you're going to be thinking about your wins and losses, and you're going to start, thinking way too quickly about how you should be positioned, instead of starting with the long-term framework that you want to be operating in. So I would just challenge all of your listeners to really think about, the first question is, what are you trying to do? What are you trying to accomplish as an investor? And then that should answer the question of what's the very first thing you should look at. And if you have those two things in line, you are going to find that the rest of your day is much more in harmony with what your investment goals are. And I think that's really important.
Excellent. Okay. Thank you very much for your time today, David. I'm sure we'll have you back on the show very soon.
Look forward to it. Thanks so much.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?